October 1907, New York City. The autumn air carries the smell of coming disaster. It begins with a failed scheme to corner the copper market, a reckless gamble by speculator F. Augustus Hines. When the bet collapses, so does confidence in the banks tied to his name. The rumor spreads that the Knickerbocker Trust Company, the third largest trust in New York, is insolvent. On the morning of October 22nd, depositors crowd the marble lobby at 5th Avenue and 34th Street. In 3 hours, they withdraw $8 million. By afternoon, Knickerbocker suspends payments. Its president resigns. The fear becomes contagious. Panic moves from trust to trust, from bank to bank, like fire-jumping rooftops. The Trust Company of America is next, its cash reserves draining by the hour. On the floor of the New York Stock Exchange, call money rates spike to 100%. Brokers cannot borrow. Stocks are dumped at any price. The exchange itself teeters on the edge of closing its doors. There is no institution to stop the bleeding. The United States has no central bank, no lender of last resort, no federal authority with the power or the cash to calm the markets. The Treasury deposits some funds, but it is not enough. The world's largest economy stands utterly exposed, dependent not on any government, but on the private judgment of a single man. That man is 70-year-old John Pierpont Morgan, the most powerful financier in America. He returns from a church convention in Virginia and installs himself at his brownstone mansion on Madison Avenue. Bankers stream to his door. Morgan reviews their books, decides who lives and who dies, who receives rescue money and who is abandoned. He commands syndicates worth tens of millions with a nod of his head. For a few desperate weeks, one aging private citizen performs the function of an entire national banking system. The panic subsides only because Morgan wills it to. But the episode leaves a haunting question hanging over Washington and Wall Street alike. What happens when there is no Morgan? What happens the day the man who saved the market is gone? To understand how close the nation came to collapse, look inside the rescue itself. On the night of November 2, 1907, J.P. Morgan gathers the presidents of New York's trust companies inside his private library on 36th Street. The room glows with Renaissance manuscripts and old master paintings. Morgan sits playing solitaire while the bankers argue in the adjoining rooms. Then he does something extraordinary. He locks the doors. He pockets the key. No one leaves until they agree to pool $25 million to save the weakest among them. Around 3 in the morning, Morgan slides a document across the table and hands a pen to the reluctant trust president, Edward King. King signs. The others follow. The crisis breaks because Morgan refuses to let them go home. This is how the world's richest nation avoids financial ruin, through the personal willpower of one man in one room. Earlier, Morgan had orchestrated the rescue of the stock exchange, summoning bank presidents and raising nearly $25 million in minutes to keep trading alive. He arranged for the city of New York, itself nearly bankrupt, to receive $30 million in bonds. He approved U.S. Steel's controversial purchase of a rival, a deal President Theodore Roosevelt personally blessed to stop the panic. Morgan was, for those weeks, the central bank the United States did not have. And that was precisely the problem. The uncomfortable truth settles over the country's leaders. A modern economy of 90 million people had survived on the fortune and the mortality of aging financiers. Morgan was 70. His health was failing. His empire was private, answerable to no voter, no Congress, no public interest but his own. The men on Wall Street understood this better than anyone. They did not want to depend on Morgan either. They wanted a system, an institution, a permanent mechanism to supply money in a crisis. But such an institution would require power, and Americans had always feared concentrated financial power. The bankers knew the public would resist. So they resolved to build their solution far from the public eye, in absolute secrecy, on a remote island most Americans had never heard of. November 1910. A private railroad car waits at a station in Hoboken, New Jersey, curtains drawn against curious eyes. The men boarding it have been instructed to arrive separately, to use only first names, to tell no one where they are going. Some carry hunting rifles as props, pretending to be a party of duck hunters. They are not hunters. They are the architects of American finance. Aboard are Senator Nelson Aldrich, chairman of the National Monetary Commission and father-in-law to John D. Rockefeller Jr. There is Paul Warburg of Kuhn, Loeb & Company, a German-born banker steeped in European central banking. There is Frank Vanderlip, president of National City Bank, the Rockefeller and Standard Oil Institution. There is Henry Davison, a senior partner at J.P. Morgan & Company, and Charles Norton of the Morgan-controlled First National Bank. Together, these men represent perhaps a quarter of the world's wealth. Their destination is Jekyll Island off the coast of Georgia, an exclusive retreat owned by a club whose members include Morgan and Vanderbilt. For roughly 10 days, in near total isolation, they draft the blueprint for a central banking system. They work in secret because they know their names are poison. Aldrich is the symbol of the Wall Street trust the public despises. If Americans learned that the nation's monetary future was being written by the very bankers they distrusted, the plan would die on arrival. So they hide. They call each other by first names, so even the servants cannot identify them. Vanderlip later admitted the secrecy was as complete as any conspiratorial cabal. What they produced was called the Aldrich Plan. It proposed a National Reserve Association, a central institution controlled by private banks that could issue currency and act as a lender of last resort. It was, in essence, the answer to 1907, a permanent Morgan, an institution that would never grow old or die, but they understood a hard political reality. A plan, written by bankers, named after Aldrich, and stamped with Wall Street's fingerprints could never pass Congress. It would have to be disguised, renamed, and sold to a suspicious public as something else entirely. The Aldrich Plan was politically dead the moment its authorship became clear. Introduced in 1911, it stalled. The name Aldrich reeked of monopoly and privilege. Populists in the West and South, Democrats who had campaigned against the money trust, wanted nothing to do with a scheme bearing Wall Street's signature. So the plan needed a new face, new language, and a new sponsor. Enter Woodrow Wilson, elected president in 1912 on a reformist platform, and Congressman Carter Glass of Virginia, along with economist H. Parker Willis. They took the essential architecture of Jekyll Island and repackaged it. Where Aldrich had proposed one central institution controlled openly by bankers, the new version scattered the structure into regional reserve banks and placed a government-appointed board in Washington on top. The private bankers who had drafted the original blueprint publicly criticized the new bill, and that criticism was a gift. It let reformers claim they had defeated Wall Street, even as the core function survived intact. The selling campaign leaned on the memory of 1907. Speeches and pamphlets invoked the panic, the runs, the terror of an economy with no safety net. The country needed an elastic currency, they argued, money that could expand in a crisis and contract in good times. They needed stability. They needed a lender of last resort, so no future Morgan would ever be required. The word emergency did heavy work. So did the word flexible. Paul Warburg, working quietly in the background, promoted the design through op-eds and academic forums, careful never to appear as its owner. The framing was masterful. This was not a banker's central bank, they insisted. This was a public safeguard, a decentralized system answerable to the government, built to protect ordinary Americans from the chaos of 1907. Critics like Congressman Charles Lindbergh Sr. warned that the bill created the most gigantic trust on earth and would establish invisible government by the money power. But the fear of another panic outweighed the fear of concentrated power. The public wanted protection, and the bankers offered it in reformers' clothing. By December 1913, the compromise was ready for a final, hurried vote. December 1913. Washington rushes toward a decision just before the Christmas recess. The bill has passed the House and the Senate in differing forms. A conference committee reconciles them in marathon sessions. On December 22nd, the final version clears both chambers. On December 23, 1913, President Woodrow Wilson signs the Federal Reserve Act into law with gold pens at the White House, surrounded by the men who steered it through. The timing, on the eve of the holiday when Congress had emptied and public attention had wandered, would be noted by critics for a century. The structure is a compromise, a deliberate balancing act. Instead of one all-powerful central bank, the act creates 12 regional Federal Reserve banks in cities from Boston to San Francisco, each owned by its member commercial banks. Above them sits a Federal Reserve Board in Washington, whose members are appointed by the President and confirmed by the Senate. The Treasury Secretary and the Comptroller of the Currency serve on it. This blend of private ownership and public oversight is the genius and the ambiguity of the design. It looks decentralized. It looks accountable. It looks like a public institution answering to elected officials. The promises are explicit and reassuring. The Fed will provide an elastic currency that expands and contracts with the needs of commerce. It will serve as a lender of last resort to end banking panics forever. It will be flexible, responsive, and ultimately under public control through the Washington Board. Supporters call it the crowning achievement of Wilson's reform program. Carter Glass takes lifelong pride in it. Paul Warburg, the quiet architect from Jekyll Island, is appointed to the very first board in 1914, his vision now clothed in federal authority. On paper, the money trust has been tamed and placed in public hands, but the Federal Reserve begins operations quietly. A modest system with limited experience and untested powers, its true reach unknown even to its founders, its independence, its capacity to create money, and its distance from ordinary voters would be revealed only under pressure. That pressure was coming fast. Within months, a war would erupt in Europe, and the young institution would be transformed into something its designers never described. The Federal Reserve opened its doors in November 1914, weeks after Europe plunged into war. It was designed to smooth seasonal money flows and calm banking panics. Instead, its first great task became financing slaughter. When the United States entered the war in April 1917, the Treasury needed to raise billions. The young Fed became the machinery. It underwrote 4 massive Liberty loan drives, keeping interest rates low so the government could borrow cheaply. Between 1917 and 1919, the national debt exploded from roughly $1 billion to over $25 billion. The Fed had discovered its true power. It could monetize a war. By pegging rates and discounting government paper, it ensured Washington never ran short of cash. This was not the modest clearinghouse promised in 1913. Member banks borrowed against their war bonds, and credit surged through the system like a current no one fully controlled. When the guns fell silent in 1918, the Fed kept rates artificially low into 1919, feeding a post-war boom and a sharp inflation that saw prices nearly double from pre-war levels. Panicked, it slammed the brakes in 1920, triggering a brutal depression that wiped out farmers and small businesses within 18 months. Few noticed the lesson. The institution created to prevent instability had just manufactured a boom and a bust. Through the 1920s, the Fed under New York Chief Benjamin Strong learned to manage money through open market operations, buying and selling securities to steer the economy. Cheap credit fueled a decade of speculation. Americans borrowed to buy stocks on margin, sometimes putting down only 10%. The Dow climbed relentlessly, from 63 in 1921 to 381 by September 1929. Strong died in 1928, leaving the system leaderless and divided over how to cool the frenzy. Some governors warned of dangerous excess. Others insisted the market would correct itself. The warning signs multiplied: soaring debt, wild speculation, an economy floating on borrowed money the Fed had helped create. The institution built to be the nation's shield now stood distracted and quarreling as the greatest financial storm in American history gathered on the horizon. It would not be ready. On October 24, 1929, the panic began. Black Thursday saw 13 million shares dumped in a frenzy of selling. 5 days later, Black Tuesday buried Wall Street under 16 million shares. The Dow, which had touched 381 in September, would eventually collapse to 41 by 1932, a loss of nearly 90%. Fortunes vanished in hours. The very calamity the Federal Reserve had been created to prevent was unfolding, and the institution froze. Banks began to fail in waves. Depositors lined up to withdraw their savings, and thousands of institutions simply closed their doors. Between 1930 and 1933, roughly 9,000 banks failed, wiping out the life savings of millions. This was the moment for a lender of last resort. This was the exact function J.P. Morgan had improvised alone in 1907. Yet the Fed did the opposite of rescue. It let the money supply contract by nearly a third. Instead of flooding the system with credit, it stood back, worried about speculation and defending the gold standard. Some regional banks pleaded for aggressive action. The board hesitated, divided, and doctrinaire. Economists Milton Friedman and Anna Schwartz would later render the verdict plainly. The Great Depression was not merely a market crash, but a monetary catastrophe the Federal Reserve deepened through inaction. Unemployment climbed toward 25%. Industrial production collapsed by nearly half. Families lost farms, homes, everything. The institution designed to be the guardian of stability had watched the temple burn. And here lies the strange paradox at the heart of this story. Failure did not shrink the Fed. When Franklin Roosevelt took office in March 1933, he declared a national bank holiday, closing every bank in the country by emergency decree. The reforms that followed, the Banking Acts of 1933 and 1935, did not punish the central bank. They centralized it. Power flowed from the 12 regional banks to a strengthened board of governors in Washington. The Fed emerged from its greatest failure larger, more consolidated, and more powerful than ever. But one constraint still bound it: the ancient discipline of gold. That final chain was about to break. Gold was the last leash. For centuries, the promise that paper could be redeemed for metal disciplined every government and every bank. The Federal Reserve, for all its new power, still operated under this ancient rule. Then, piece by piece, it disappeared. The first cut came in 1933. Franklin Roosevelt, battling the Depression, issued Executive Order 6102 in April, ordering Americans to surrender their gold coins and bullion to the government at $20.67 per ounce. Hoarding gold became a crime. Months later, Roosevelt revalued gold to $35 an ounce, devaluing the dollar by fiat overnight. Citizens could no longer redeem their currency for gold at all. The internal link was severed. Only the external one remained. That surviving thread was formalized in July 1944, when delegates from 44 nations gathered at Bretton Woods, New Hampshire. They built a global system anchored to the dollar, and the dollar alone anchored to gold at $35 an ounce. Foreign governments could still exchange their dollars for American gold. The United States became the world's banker, its currency, the reserve of the planet. But there was a fatal temptation buried inside this arrangement. America could print dollars to fund its ambitions, and the world had to hold them. Through the 1960s, the costs of the Vietnam War and expanding social programs poured dollars abroad. Foreign nations, especially France under Charles de Gaulle, grew suspicious. They began demanding gold in exchange for their paper. American gold reserves drained steadily from over 20,000 tons after the war toward a dangerous low. The run had begun, only now the depositors were entire nations. On August 15, 1971, Richard Nixon appeared on television and announced he was closing the gold window. The dollar would no longer be convertible to gold for anyone, foreign or domestic. He called it temporary. It was permanent. In a single stroke, the last external constraint on the Federal Reserve vanished. From that night forward, money was backed by nothing but confidence and decree. The Fed could now create dollars without limit. The final chain had fallen, and the age of unbounded emergency was about to begin. Freed from gold, the Federal Reserve entered an era of pure discretion, and each crisis expanded its reach. In autumn 2008, the pattern that began in 1907 returned with terrifying force. Lehman Brothers collapsed on September 15th, its 158-year history erased overnight. Credit markets froze. This time, there was no J.P. Morgan locking bankers in a library. There was the Fed, and it acted on a scale beyond imagination. Chairman Ben Bernanke slashed rates to near zero and launched quantitative easing, creating money to buy trillions in bonds and mortgage-backed securities. The Fed's balance sheet swelled from under $1 trillion to over $4 trillion. It rescued not just banks but insurance giants and automakers, choosing which institutions lived and died. Emergency lending programs were invoked under authorities dating back to the Depression. The temporary tools became permanent fixtures. Interest rates stayed near zero for 7 years. Then came 2020. When the pandemic struck, the Fed unleashed everything at once. In a matter of months, it created over $3 trillion, backstopped corporate debt, and pushed its balance sheet toward $9 trillion. Money printed since the founding took a century to accumulate. A large share of all dollars in existence was created in a single burst. The inflation that followed, peaking above 9% in 2022, was the bill arriving. Look at the arc. An institution sold as a temporary emergency fix in 1913, promised to be accountable, flexible, under public control, yet its chairman is unelected. Its most powerful decisions are made in closed meetings. It answers to no vote and reverses no policy at the ballot box. Every panic since 1907 has justified more power, and none of that power has ever been returned. The lender of last resort became the first resort, the permanent backstop, the invisible hand steering the entire economy. The emergency was never declared over because the emergency was the point. It was the justification, renewed with each crisis, that let a private-public hybrid grow into the most consequential financial force on earth. This is the final reckoning. The temporary fix became permanent power.